Right now, there are over 11 million mortgages in America with interest rates below 3.5%. Rates from 2020 and 2021, locked in, legally transferable. They're called assumable mortgages. And if you find the right one, you could save more than $186,000 in interest compared to whatever your bank is quoting you today. This isn't a loophole that's about to close. It's built into federal lending guidelines. But 97% of buyers and most real estate agents have no idea how the process actually works, until now. An assumable mortgage is exactly what it sounds like. You take over someone else's existing home loan, their interest rate, their remaining balance, their original terms. The seller's mortgage doesn't get paid off at closing. It gets transferred to you. Think about what that means in today's market. The average 30-year fixed rate right now is hovering near 7%. But millions of homeowners locked in rates between 2.5 and 3.5% during 2020 and 2021, the lowest rates in recorded American history. Those loans didn't disappear. They're still active, still accruing at those rock-bottom rates. And a significant portion of them are legally assumable. The key word there is legally. This isn't some workaround or creative financing trick. The right to assume these loans is written directly into the original loan documents. Here's what most people get wrong. They assume all mortgages are assumable. They're not. Conventional loans backed by Fannie Mae and Freddie Mac almost always include a due-on-sale clause. That means the full balance comes due when the property changes hands. No assumption allowed. But three types of government-backed loans are different. First, FHA loans insured by the Federal Housing Administration. Every FHA loan originated in the last 50 years is assumable. Every single one. Second, VA loans guaranteed by the Department of Veterans Affairs. Also assumable, and here's what surprises people, by non-veterans too. You do not need military service to assume a VA loan. Third, USDA loans, less common but fully assumable. Now here's the number that matters. Between 2020 and 2022, roughly 14 million government-backed loans were originated. The vast majority carry rates under 3.5%. That is an enormous pool of assumable debt just sitting there waiting. Let's run the numbers side by side, because this is where it hits home. Say you're looking at a property listed at $350,000. The seller has an FHA loan with a remaining balance of $250,000 at 3%, with 25 years left on the term. If you assume that loan, your monthly principal and interest payment comes to $1,186. Now compare that to a brand new 30-year mortgage at today's rate of 6.8% on that same $250,000 balance. Your monthly payment jumps to $1,632. That's $446 more every single month. But here's where it gets staggering. Over the life of the assumed loan, you'd pay roughly $105,000 in total interest. With the new loan at 6.8, $291,000. The difference, $186,000. Same house, same neighborhood, same purchase price. The only variable is which loan you're paying on. This is where most people hit a wall. Assumable mortgages aren't flagged in standard MLS listings. Most agents don't think to ask about them, but there are concrete ways to track them down. First, dedicated platforms. Rome, AssumeList, and FHA Loan Search are online marketplaces built specifically to connect sellers who have assumable loans with interested buyers. They're growing fast and adding new listings every week. Second, target the right neighborhoods. Areas with high concentrations of FHA and VA loans. Think communities near military bases, first-time buyer subdivisions, and suburban developments built between 2019 and 2022. Third, and this is the move most people miss, go direct. When you find a home you like, ask the seller's agent one simple question. What type of loan does the seller currently have? If it's FHA, VA, or USDA, it's assumable. Period. You can also search public records. In most counties, the deed of trust indicates the loan type. A 30-minute records search can uncover exactly what you need. Now let's walk through exactly what happens once you find an assumable mortgage you want. Step 1. You and the seller agree on a purchase price, just like any normal transaction. Then the seller contacts their loan servicer and requests an assumption package. Step 2. You complete the assumption application. It's similar to applying for a new mortgage. You'll submit income documentation, tax returns, bank statements, and your full credit history. The lender needs to qualify you. They're not just rubber stamping a transfer. Step 3. The servicer underwrites your application. They're evaluating your creditworthiness, your debt-to-income ratio, employment stability. For FHA assumptions, you generally need a minimum credit score around 580. VA assumptions are similar. Step 4. Once approved, you proceed to closing. The loan transfers into your name with the original interest rate and terms completely intact. The seller is released from all liability on that mortgage. Sounds clean, right? But there's a critical piece that most guides completely skip, and it's the part that makes or breaks whether this actually works for you. Here's the biggest obstacle in any mortgage assumption, and the #1 reason deals collapse before closing. Remember that 350 house with a 250 loan balance? That $100,000 difference is the seller's equity. You need to cover that gap. You can't just assume the loan and walk away with free equity. So how do you bridge it? Option 1, cash. If you have $100,000 in liquid savings, problem solved. But most buyers don't have that sitting around. Option 2, a second lien. This is by far the most common solution. You take out a second mortgage or home equity loan specifically for the equity gap amount. Yes, that second loan will carry a higher rate, probably 7 to 8%. But run the math. You're paying 8% on $100,000 and 3% on $250. Your blended effective rate comes to roughly 4.4%. That is still dramatically lower than 6.8 on the full purchase price. Option 3, seller financing. Some sellers will carry a promissory note for part of the equity gap, essentially acting as your second lender. This is more common than you'd expect, especially when homes have been sitting on the market. Option 4, down payment assistance programs. Multiple states offer grants and subsidized loans that can help first-time buyers cover this exact type of gap. Let's set expectations right now, because speed is not the strength of this strategy. A conventional mortgage closes in 30 to 45 days. An assumption, plan on 60 to 90 days minimum. Some take 4 months, a few drag past 6. The bottleneck is almost always the loan servicer. Most servicers aren't built to handle assumptions at scale. They process thousands of new originations every month but might see only a handful of assumption requests all year. Paperwork gets shuffled between departments. Phone calls go unreturned for weeks. This is critical to communicate to the seller from day one. They need to understand that this will not be a standard 30-day close. If the seller needs to move quickly, say they've already bought another home, an assumption probably isn't the right fit. But if they're flexible on timing, and especially if the assumption helps them sell at full asking price in a slow market, the deal can absolutely come together. Patience isn't just helpful in this process, it's the entire game. VA loans deserve their own section because there's one detail that changes the entire negotiation. When a non-veteran assumes a VA loan, the original veteran's entitlement, their earned benefit from military service, stays tied to that loan until it's fully paid off. That means the veteran seller cannot use their VA loan benefit to buy another home for potentially decades. This is a significant sacrifice. Some veteran sellers won't agree to it, and you need to respect that. Others will, especially if the assumption helps them sell at full asking price in a difficult market. But here's the key detail. If another veteran assumes the loan, the original veteran's entitlement can be fully restored through a process called substitution of entitlement. This is a dramatically better outcome for the seller. So if you happen to be a veteran yourself, you're holding a powerful card. Lead with this in your offer. Tell the seller their VA entitlement will be restored upon closing. It costs you nothing to offer, and it can be the single factor that turns a no into a yes. Before you start making offers, let's talk about what can go wrong, because going in informed is how you avoid becoming a cautionary tale. Pitfall 1, servicer resistance. Some loan servicers will stall, claim that assumptions aren't possible, or simply lose your paperwork. They're wrong about the legality, but you may need to escalate site-specific HUD guidelines by number or bring in a real estate attorney to force the process forward. Pitfall 2, the appraisal. The lender will likely require a new appraisal. If the home comes in below expected value, your equity gap calculation shifts and your entire second lien structure changes with it. Pitfall 3, second lien costs. That bridge loan will not be at 3%. Run the complete blended cost including origination fees and closing costs before you commit. A bad second lien with excessive fees can erode a surprising amount of your interest savings. Pitfall 4, title complications. Assumptions require clean title transfer. Any existing liens, tax judgments, or ownership disputes on the property can delay the deal by months or kill it entirely. Pitfall 5, opportunity cost. While you're waiting 90+ days for a servicer to process your assumption, other properties will come and go. Always maintain a backup strategy. If assumable mortgages are this powerful, why aren't they everywhere? There are 3 structural reasons, and once you understand them, you'll see exactly why this is an advantage for you. First, loan officers have zero financial incentive to help you assume a mortgage. They earn commission on new loan originations. When you assume an existing loan, the loan officer makes nothing. Zero. They will never bring this up voluntarily. Second, most real estate agents have never processed an assumption in their entire career. It's not covered in standard licensing courses. Agents instinctively avoid transactions they don't understand, and they'll steer you toward a conventional purchase every single time. Third, until very recently, there was no efficient way to even search for homes with assumable loans. That's finally changing with platforms like Rome and AssumList, but mainstream awareness is still shockingly low. This information gap is your structural advantage. While millions of buyers compete for new mortgages at 7%, a small number of informed buyers are quietly assuming existing loans at 3% and saving 6 figures in the process. That can be you. Here's your roadmap. 5 concrete steps you can take starting today. Step 1. Create accounts on Rome, AssumList, and FHA Loans Search. Set up alerts for assumable listings in your target markets. These platforms are free to browse and new listings appear daily. Step 2. Find a real estate agent who has actually closed an assumption before. Ask them directly, how many mortgage assumptions have you handled? If the answer is 0, keep looking. Experience matters here more than almost any other type of transaction. Step 3. Get pre-qualified for a second lien now, before you even find a property. Know exactly how much equity gap you can cover and at what interest rate. This defines your real budget and prevents surprises mid-deal. Step 4. Set your timeline expectations. Tell your family, your landlord, your employer this process will take 90 days or more. Remove that stress before it starts. Step 5. Retain a real estate attorney who understands assumptions. This is not optional. Assumptions involve legal nuances that a standard title company or closing agent can easily miss. And one final thing to remember. The window on these ultra-low rates is not permanent. Every year, more sellers refinance, pay off their loans, or sell through conventional channels. The pool of mortgages at 3% or below gets smaller with every passing month. That is how you legally assume someone else's mortgage at 2.5 to 3.5%. Every step, every pitfall, no gray areas. If this changed how you think about buying your next home, hit subscribe. We break down the strategies that lenders and agents aren't going to volunteer. And drop a comment below, have you started looking into assumable mortgages? I want to hear what you're finding out there.